What's going to happen in the markets in the last 3 weeks of the year? Well, it all may depend on what happens this week. Our next guest says you can expect a Santa Claus rally, but only if there's progress made in solving the debt crisis. Brien is a strategist at DRW Trading Group. Lou, welcome to In Business. How do you define progress?
Well, that's a good question. I guess I'll define progress with how the market defines progress. I mean, the market, the S&P has been held hostage to the next headline out of Europe and the one after that for quite a while now. And with the important ECB meeting tomorrow and the EU summit on Friday, we'll have to see how the market takes that. It's really not very clear right now, even though we've had a lot of ideas floated, what they're going to agree to or whether the market will decide that that's a sustainable program going forward. You know, in these situations, therefore, you know, the markets tend to fall back on the charts, and such has been the case for the last several months in the S&P in particular. You know, at the late November, we went down to 1158, which was a very key and obvious support level, and the market held like a champ. Now, going into this meeting, we're really kind of the next key resistance level would be up at the October high at 1292. Should we get through that, there's nothing really in the way, and a Fibonacci projection could put us back at the May highs. But that's a lot of ifs, because we don't know, you know, not only how what will be presented at this meeting, particularly how the various countries will determine how much more sovereignty they want to give up. Right. Or if at the end of the day, even with the ECB and bailout funds, whether the market will decide that the sovereign debt in Europe is investable rather than just tradable. And finally, we'll have to see how the S&P in particular decides how they view the decisions made and whether or not they will act on their credit watch negative for Europe.
You just gave me a whole lot of caveats to a Santa Claus rally. So,
well,
given that, though, like, how do you position yourself before the end of the week? And if you don't get some of those deliverables you're hoping for?
Well, I mean, I would think you would position yourself very carefully here because there is a lot of risk at the market. I don't think these are one of those situations. If you're a very risky trader, you might roll the dice one way or the other on it. But so I don't think that this is necessarily an investable decision. Well, you know, that might, you know, what's safe depends, you know. There is a lot that depends. I mean, safe might be on the sidelines in front of these sorts of things. You know, on the other hand, the Treasury market, which can also be whipsawed by the headlines out of Europe. You know, even though the yields are so low because of the flight to quality, mainly because of the fear of European debt and what might happen there. It's been a safe haven. But there's also in the Treasury something that might be a little more lasting than a fickle flight to quality trade, and that's something I call the flight to quantity. You know, the buffet of debt offerings in the U.S. has been diminished since 2009. So even though we, for instance, have 60% more 10-year notes on auction, the demand for those has gone up 100%. And now that you have the European situation and that institutions have decided that the European sovereign debt is not necessarily investable, maybe tradable, not investable, therefore the buffet has shrunk even further. And so even as the flight to quality trade depends on the next headline, the treasuries are in many regards the last man standing. You know, and a good example, a stark example of that was yesterday's 4-week T-bill auction. The Treasury sold $35 billion worth of 4-week bills, $35 billion. There was $268 billion bid for, a bid to cover, as they say, of 7.66 to 1. I've never seen a higher one, nor have I ever seen more bid.
Explain to the everyday investor why that's significant.
The yield for that paper was 0. In other words, you had a guarantee that you would get the money that you invested back and nothing more. That's important because, one, it's a flight to quality. It's a fear trade. In other words, we don't know where else to put this money over the next 4 weeks to guarantee that it gets back, and we have to put it somewhere.
And you were seeing that with the German bond, too.
Well, yeah, I mean, there's just a much more limited universe of what to invest in. That has benefited the treasuries, I think, in a very big way. And as I say, I mean, how do you position yourself? Probably under your desk and just see how, you know, see where the smoke clears.
Well, it sounds like Santa might be scared away there, Lou, about that.
Well, I don't know.
Scenario.
I mean, the point is I don't know, Margaret, and I don't know that anyone can have any certainty.
Right. No, and one of the reasons why we're seeing volume the way we are right now. Lou, thank you very much for giving us your perspective. We've got to leave it there.